Hello everyone, my name is Rajat and today I'm going to talk about 100 questions around credit risk. All the important topics which you can think about the credit risk portfolio when you are going to apply a job in a bank or in a service based company in India. Okay, so the topics are going to be PD, LGD, EAD, what is credit risk, what is Basel, what is IFRS 9. So I am going to give you 100 questions from the interview perspective. Many of the subscribers were asking me that Rajat, please give us 100 questions. So I am giving you 100 questions which can lead you to crack any interview from the domain perspective. Now, without wasting your time, I'll take you forward and let's move ahead. Let's start talking about these questions. Now, to sum it up in a proper way, I have kept all those questions into this document and I have thoroughly went through all of them so that it can help each one of the member, right? So the format is going to be, it's going to be starting from the beginner level, as you can see on your screen. From beginner it will go to intermediate, then it will go to the expert. There are 100 questions. I'll take you through each one of them quickly and then you can go through this document which you can download from my GitHub repository without any charges. You can free of cost take it, download it, use it, prepare for your next interview. Okay, so now let me quickly start talking about primarily what is credit risk. So obviously credit risk is a kind of a risk which bank have out of so many other type of risk, where the counterparty fails to meet its financial obligations as agreed between those two parties. That's what the credit risk is. Okay, now let me quickly try to open my pen, then we can talk more. Okay, see, in this, if you going through the whole line, this will give you a proper meaning. That's why I have kept it so much to the point that you can go through it. Okay, every question is to the point only. So credit is the possibility that a borrower or a counterparty fails to meet its financial obligations as agreed. So who is the party? I as a customer and the bank. It arises in lending, trading, investing, any of these activities. Okay, so all of you can see that. Now credit risk is crucial to prevent financial loss for bank and investor. It involves accessing the credit worthiness. What is credit worthiness? You should know it by now. Okay, of a borrower and setting appropriate limit like credit card limits and all, or the loan limits, all of that. Okay, now let's move on to the next one. What is default? So what is default? Default is when a customer is failed to meet the financial obligations of the bank. Simple. Now I have tried to sum it up in 4 to 6 lines maximum. Okay, so you can read it through, you will get it. Now what is probability of default? So probability default is the likelihood that a borrower will default in financial obligation. It's to the point, guys. Okay, now next question is, what is LGD, loss given by default? So it represents the portion of exposure that a lender will lose. What is lender? Bank. Okay, lender is a bank. If a borrower default, who's a borrower? A customer like you and me. After accounting for recoveries, it is expressed as a percentage of the exposure at the time of the default. It can happen anytime, guys, right? Maybe in the first 6 months of the loan, within 2 years of the loan, so all of that. Okay, so that is what the meaning of the time here. Now LGD is influenced by the collateral, recovery process, legal factor, and so many other things. Pretty easy. What is EAD? So EAD is the total value of a lender is exposed at a particular time when a borrower is default. Let's say I had a loan of 10 rupees. If I defaulted the price when the loan was 7 rupees, so now that is the value of EAD. If I defaulted when the loan was left only 3 rupees, so that is the value of EAD. Now what is next question is, what is expected credit loss? So it's the byproduct of three of them, like PD, LGD, EAD. When you multiply all of them together, that is known as a expected credit loss. And then I would say read through it. You should read all the 4 or 5 lines, because if I read all of them, it's going to take so much time out of you guys. Okay, but if you'll have any question in any of these, right, don't hesitate to put your question in the comment section. I will reply. Now, how is ECL calculated? So ECL is calculated by multiplying PD, LGD, EAD for each exposure. Each exposure means each case. Okay, then adjusted by the time value of money. So this is the formula. and calculation may vary depending on whether it's a 12-month or a lifetime ECL, depending on which model the bank is using, maybe Basel or IFRS 9. So all those things also sometimes do matter, right? Now, what is IFRS 9? IFRS 9 is an international financial reporting standard for financial instruments. Instruments means any loan portfolio, any credit card portfolio, all of them are instruments. Okay. It introduced a forward-looking approach for credit loss model of impairment. What is impairment? As in you are going to lose something, right? So IFRS 9 replaced the old standard and aim to enhance transparency and comparability. It classifies financial assets based on business model. So it's a regulatory model. Okay. Ultimately, the bank has to report to the regulator in that country. Like in India, it's RBI. In Canada, it's OSFI. So it's basically referring to all those government body. Okay. Now, what is the 3-stage model in IFRS 9? So in IFRS 9, there are 3 stages. It's pretty much clear that when you are going to talk about IFRS 9, there are always 3 stages. So stage 1, stage 2, stage 3. Now, what is the difference? In stage 1, no significant increase in credit risk because you are calculating the ECL for only first 1 year, which is 12 months. Stage 2, you are calculating the ECL again lifetime. Okay. Now in the stage 3, you calculate the ECL with adjusted interest income also. What is interest income? When you give a loan, so obviously you are going to get some interest out of that. So interest income need to be adjusted. That is a lifetime calculation. Similarly, you calculate PD, LGD, EAD in 3 stages. It's very important. So you should know that about IFRS 9. Now, what is Basel? Basel is a set of international banking regulations by the Basel Committee. Okay, Basel is a place and also it's a committee that decides all these standards. It ensures that the lending, who is the lending? The bank, and investment activities align with the institute risk appetite. What is the meaning of that? That bank should be having the capability to meet the financial obligations even if the people are not paying back the loan. So bank should have that much of capital so that market should not be suffering, or the retail investor like us who are having savings account, current account, fixed deposit. So all those people should not be suffering. So that's to protect that all these committee came into the picture. Now, what is credit scoring? Credit scoring is a statistical technique used to evaluate, or you can say to calculate, borrower credit worthiness. Now, credit worthiness is a very important term. What is how much risk a customer can take? What is the credit worthiness of the customer? That is the main goal which every company want to know or a bank want to know before they are giving any of the product to that particular customer, right? Based on the various factors, it assigns a score that predict the likelihood of a defaulter. So it's pretty much clear. Now, what is credit rating? Obviously, there is a rating given to the customer, okay, by the agencies or the credit agency, or the bank also give them the rating internally. So you should know all this terminology, obviously, because these questions can be asked to you in any of the interview, like what are the credit ratings in your company? So you should be having a proper answer. Like there are credit buckets, like high risk bucket, medium risk bucket, low risk, all of those things should be answered in your interview. Otherwise, you are not going to crack the job one. But after this document, you are going to do that. You can achieve that. Now, what is the collateral? Collateral is an asset pledged by the borrower to secure a loan. Let's say I went to the bank, I gave some gold ring. Against of that, I took a loan. So that gold ring is a collateral. Similarly, in house loan, if you're not going to pay the loan back to the bank will take your house. That is a collateral. Okay. And also that is known as a mortgage loan. Mortgage and collateral, somewhere there is a thin line. I'll tell you maybe in some other video. Now, that is the collateral which is pledged. So what is the credit exposure? That how much the total exposure is at the risk right now. Now, these are the very basic questions. Let's move on to the some. See, numberings are a bit off here. So I think that I'll change. Don't worry. What is the IRB approach? So IRB approach under Basel allow the bank to use their own internal model to estimate credit risk parameters. Okay. That is known as a IRB approach. Okay. That's why it's called internal rating base. So bank has to report it. Now, what is credit risk mitigation? That is known as a CRM. Every bank have CRM teams. So you should be knowing that what is the role that team is playing in the bank. Their role is to let the bank know that there is a risk involved in any of the portfolio which you are running, and these many customer can default, these many customer can go delinquent. All of that reporting need to be done. Now, what is credit derivative? Credit derivative is a financial instrument that transfer credit risk from one party to another without transferring the underlying assets. Simple English, guys, not much complexity. What is credit concentration risk? Okay, so credit concentration risk arise when a significant portion of the exposure is single counterparty or a single sector. Sometimes bank give the loan to the big companies, and if the company default, because the loan size in billions, right, sometimes, so that totally depends. Now, the concentration should be always diverted. What do you mean by that? Now, when we talk about the diversification, bank should not give the loan just to like construction company. They give to construction, petroleum, and infrastructure, everything, so that if one sector goes down, other sector should go up. Some sector should be going up, because if you put all your money in financial sector, suddenly one bank is bankrupted, so the everything will go down, right? What is counterparty credit risk? CCR is the risk that counterparty is a financial transaction default before settlement. Okay. Now, let's move on to the next one. What is the credit valuation adjustment? So you can walk it through. Is a simple adjustment to the fair value of the derivative instrument to reflect counterparty credit risk. What is a counterparty credit risk? Let me explain it in a single way. When there are two parties involved in the business, that is known as a counterparty credit risk. Let's say one bank is selling the bond to another bank, so now there are two banks involved, so that's why there are two parties. So it's always, let me read it through so that you'll understand more. It represents the market value of the risk of counterparty defaults. CVA reduces the valuation of derivative based on the creditworthiness of the counterparty, which is the other side. It becomes prominent after 2008 French financial crisis, when the Lehman Brothers got bankrupt, and regulators now require CVA risk capital under Basel III. Okay. Now, what is wrong way risk? So you can read it through. Let me talk about more important questions now, because I'm going to give you the document, so you'll be able to read it through. What is credit spread? Obviously, it's important. So credit spread is the difference in yield between a risk security and risk-free benchmark of similar maturity. It reflects the market assessment of credit risk. Also, credit spread wide when risk perspective or perceptions increases. They are used in pricing. It's very much understandable. Okay. What is CPM? Credit portfolio management. Every bank have a team where they are managing the portfolio. What is the standardized approach of credit risk? So under Basel 1 and 3, or 1, 2, 3, all of them, the standardized approach assign risk weight to the exposure based on external credit rating by external companies like Experian, Equifax, all of them. Okay. What is RWA? Risk weighted assets. So RWA is the value of asset adjusted for risk under regulatory capital calculation. There are separate team in banks. They are only working on the calculation of RWA. So each of this question, like all these questions which are there in this particular file, every question belongs to maybe sometime a different team in the bank, because there is a separate team who, they are just working on RWA. Now, let's move forward. What is a pillar 1 of Basel? So you can read it through. What is a pillar 2, pillar 3? Everything is clear here. What is the minimum capital requirement under Basel 3? So that has been increased significantly. Okay. So once you'll read it, now currently Basel 3 require bank to maintain a minimum tier 1 ratio as 4.5%, plus a capital conservation buffer of 2.5. If you add it, so it's 5 and then 7%. Total minimum capital requirement is 8%. Also, this value sometimes is changed by the country to country. Some country can say to their bank, I want to keep it 9%. That's totally good for us. Now, next question is, what is the common equity tier 1? So you can read it equity tier 1 capital, what is tier 1, what is tier 2 capital, how they are used, all these questions are covered. Then what is the capital adequacy ratio? There are separate teams who are working only on CAR model. Okay, so CAR is a ratio of a bank capital to its risk weighted assets. Here are the formula. CAR equal to tier 1 capital, tier 2 capital divided by risk weighted assets. So you can read it through and you will understand. Now what is the leverage ratio in Basel 3? What is the liquidity risk bank have? Liquidity risk obviously is pretty much clear, that how much money they have in the bank, like the liquid money which they can return to the borrower right at this point. That is liquidity risk. Okay, what is a liquidity risk? Coverage ratio, pretty much clear here, you will read it. What is a net stable funding ratio? It's clear. Operational risk is also mentioned. Then market risk is mentioned. See, there are three major risks. Now, why I stopped at this question? Because this is pretty much asked. Sometimes people are confused. Market risk is a separate portfolio. Credit risk is a separate portfolio. Operational risk is a separate portfolio. The biggest of them all is credit risk. Number two, size wise, money wise, is market risk. Number three is operational risk. Okay, so now it's your choice which area you want to go. What is a standardized approach of operational risk? Every type of risk have a approach which is standardized by the bank. What is the meaning of standardization? That there are certain factors which have to be calculated. So that is what I meant here in this answer. Now what is the expected shortfall in risk management? Read it. What is stress testing? It's important. Now stress, when we say that I am having stress, so much stress, what does that mean? That I am thinking about something and that is something giving me attention. So similarly, bank has to do some stress testing on their value. Let's say they have a credit card portfolio in any region. Okay, let's say in California. So when bank is checking that in California, if my people, like my customers, usually default, everybody default, so how much stress should come on me? That is known as a stress testing. So bank usually try to predict the risk involved. It's a future driven approach which all the bank has to follow. Okay, now let's go to some advanced question. So what is the expected credit loss under IFRS 9? So as of now, I told you about IFRS 9 and ECL separately. Now ECL have an approach, so which you should understand, that it's a forward looking approach for credit loss considering possible default event and their possibility. It reflects lifetime losses of impaired assets which are not so profitable. That's what I meant by impairment. For 12-month loss for performing ones, IFRS 9 require financial institute to recognize ECL from the date of initial recognition. This approach improved transparency in financial reporting, ECL, and basically calculation of PD, LGD, EAD all are in stages. That's how we calculate ECL in this. What is lifetime ECL? Obviously, which you calculate after a 12-month. Initial 12-month is kind of an impairment period. Okay, so step 2 is your lifetime ECL, or stage 2 you calculate lifetime ECL. What is 12-month ECL? There is a clear difference which I mentioned here. What is stage 1 in IFRS 9 impairment? What is stage 2? I told you in brief. Now you can read it much more in detail. Now what is significant increase in credit risk? Pretty much easy. Credit impairment assets, it should be easy for you. And then what is a forward looking information concept under IFRS 9? Because this is a forward looking approach. As I said, that it's in 3 stages. So by now you should be having why it's a forward looking, right? Because you are looking at the future, like 12 months, then lifetime, all those calculations we do in the bank. I am part of those teams. I usually do that from my experience in last 12-13 years. And what is the impact of IFRS 9 on financial institutes? It's a framework, so they need to follow. What is the capital conservation buffer? You will read it, you'll get it. What is the counter cyclic capital buffer? It's also easy. What is the liquidity coverage ratio? Now it's important, LCR. So LCR ensure that the bank have enough high quality liquid assets to meet short term obligation. Let's say the bank has to give the money to so many customers maybe this week. So bank should be having enough liquidity that the transaction should not stop. That's what it meant. Now what is a net stable funding ratio. What is the role of Basel 3? It's a guideline. What is our leverage ratio under Basel 3? What is systematic risk? What are global systematically imported banks? What are they? You'll get it. What is the internal capital adequacy assessment process, which we call ICAP? It's an important term used in banks. So I would say remember the full form also. Sometime they will refer as ICAP. You should know the full form. Now, what is the stress testing in Basel? How it's done? What is the recovery and resolution planning? RRP. What is the total loss absorption capacity of a bank? Pretty much easy. What is the risk appetite? RAF. What is credit risk governance? There are separate teams in bank like credit risk governance. Their sole job is to make sure that the bank is having proper governance. Okay, so that's what I am trying to convey here. What is the adjusted risk on capital? This is also important. What is the role of credit committee? Credit committee is the committee that actually take care of everything. They usually look after all the banks. Okay, now what is risk data aggregation and reporting? There are teams for this also. You will read it easy on this one. What is a model risk management? Now MRM is an important term. See, MRM is a team name. Sometime in MRM you will see in many bank 300 400 people working in MRM for different product. Okay, so MRM address risk arising from the use of financial model in the decision making. It includes model development, validation, governance, and monitoring. That's how we have all these people working in MRM, because validation, developer, governance, monitoring, all of them are part of this team. Now, the 100 question is, what is the importance of compliance with Basel and IFRS 9? Compliance ensures financial institute meet regulatory standard for capital adequacy, risk management, so the bank have the enough fund so that the operation should not stop even if the customers are defaulting in some of the loans. Okay, it support market confidence obviously, and Basel and IFRS 9 align risk management with global best practices. Continue compliance reflect strong governance and sound business practice. Now guys, see, this is the whole and soul of this video, and I prepared this document after putting all those questions which I also used to consume myself when I was a fresher. And if you read this document thoroughly, and I'll show you the link as well. So this is the link. It's already there on my GitHub repository. I would say you just go inside the crack interview and then download this. It should be easy. Okay. Now on that note, if you like this video, I would request you to subscribe to my YouTube channel and share this video with your friends who want to work in the credit risk area or market risk, or they are preparing for their job interview in any of the banks. On that note, I would like to take leave from all of you. I'll see you in the next video. Thank you so much.